Right, so if we get straight to it then, our first speaker is Dr. Kyriakos Chousakos. He's Vice President, Data and Innovation Group, a part of the scientific implementation team at Bank of America. And I'm delighted to have him on board. He'll be speaking about harvesting macroeconomic risk premia. Over to you, Kyriakos.
Good morning, everyone. Thank you, Tom. I would like to thank the organizers for the invitation to present our work in this seminar, open forum conference on macroeconomic risk premia, as Tom said. So this presentation is based on a Journal of Portfolio Management paper that Daniel Jamoridis, who's the global head of the team, and I authored a while ago. And the origins of this work can actually be traced back to client meetings in which we talked a little bit about styles, factor portfolios, drivers behind performance of those portfolios. And always one thing that came up again and again was, how are those things related to aggregate economic activity? How are those things related to macroeconomic factors? So one way to think about this is the following. And here, what we're doing is we're using Illmanen's work on expected returns on major asset classes. And what we see is that risk and return can be thought across multiple dimensions. The very first dimension that one can see is that of asset classes. So different asset classes have different risk-return characteristics, and those risk-return characteristics organize our thinking around how we can combine them into portfolios. Then there is a second dimension that one can consider, and that second dimension has to do with organizing those individual asset classes across specific characteristics, and those characteristics have to do with trend, volatility, value, carry, and so on and so forth. But on top of that, one can think about a third dimension, and that third dimension is more related to aspects of the macroeconomy. And those aspects of the macroeconomy are growth, inflation, tail risks, economic sentiment, and so on and so forth. So what we wanted to do was we wanted to create a unifying framework within which one can consider multiple asset classes, but at the same time, multiple strategy styles. One main observation is that expected returns of financial assets do indeed vary with the business cycle. And we see that some assets tend to outperform when the economy is doing well. Those are called pro-cyclical assets. And other assets tend to outperform during recessions. Those are counter-cyclical assets. As you can see at the bottom left graph, the average returns of equities, fixed income securities, commodities differ depending on which phase of the business cycle we are in. So this is something that we wanted to explore further in a proper framework. Now, one big challenge in this exercise is, how do we define economic activity? There are multiple measures out there reported by either private or public agencies that are trying to describe and provide a depiction, a snapshot of macroeconomic activity at any given point in time. Of course, the frequencies at which that data is reported vary from weekly to biannually. And what we see is that economic data is released almost on a daily basis. So that gave rise to ideas of nowcasting, how one can incorporate that information in real time to get a better depiction of where the macroeconomy stands at any given point in time. Our way of approaching this problem is a little bit different than nowcasting. We are doing that, but we are focusing a little bit more on capturing more medium term changes in the macroeconomy. And the way we do that is by using advances in macrofinance and machine learning techniques, which actually allow us to identify the relevant measures out of this large universe of macroeconomic measures. It also helps us construct more accurate measures at higher frequencies than the frequencies at which the data itself is reported. And then having that information, we actually construct portfolios that have specific properties with respect to the macroeconomic theme that we're targeting. So in this version, we are targeting 5 different macroeconomic themes related to output growth, inflation, sentiment, fragility, and volatility. There can be more, and the engine that we have constructed can handle multiple macroeconomic themes. These are the ones that we have a high conviction on, and these are some of the measures that have the right quote-unquote properties. And I'll get to what I mean with right properties. So first of all, we have the output measure, which is a single measure of aggregate economic growth. How do we construct this measure? We start from a set of individual macroeconomic variables that you can see at the bottom left of this slide. Things related to industrial production, capacity utilization, retail sales, manufacturing PMI, and so on. We're trying to capture aspects of the macroeconomy that are related to aggregate economic growth, and these are variables where we see a consensus in the literature around their properties and why people combine them together. Now, once we have those individual measures, we're using a robust cross-sectional technique, which is more or less an advanced version of a PCA analysis, to produce a single series of that describes aggregate economic growth. The series can be seen on the right-hand side, and what one can observe directly is that it tends to attain its lowest values during times of economic downturn. As you can see, that happened in 2001 and 2008, and then you can see the large dip, which is the recent recession that we are in. This is a pro-cyclical measure. As I said, the lowest values are attained during times of economic downturns. The frequency at which we're showing this measure here is monthly, but the measure can also be computed on a daily basis. The reason we're choosing monthly is the fact that we have seen that the signal that's being derived out of this series seems to be the strongest around the 1 month interval. Now, once we have this measure, and before we move forward to starting deriving signals and constructing a proper tactical asset allocation framework, we would like to make sure that this measure does actually have the right properties. And the way we go about testing that is we are looking, we're estimating a VAR model in which the estimates of which we're using to construct cumulative impulse responses. And what we see from those impulse responses is that a positive shock in this output measure is associated with a positive response over the next 10 months or so in consumer confidence, industrial production, and non-farm payrolls. And the way we interpret those results is that this is an additional sanity check that the measure that we have constructed does actually have the intended properties. So it's pro-cyclical and it's related with the output aspect of the business cycle. Now, in a similar way, we are constructing a single measure for inflation. We start again with a set of macroeconomic variables that are related to inflation. And then from that, we produce a single measure, again, on a monthly frequency. What we see in our tests is that this measure doesn't necessarily have a clear relationship with the business cycle. It's either acyclical or weekly pro-cyclical. The third measure that's constructed using this methodology is that of economic sentiment. Again, we're starting from a set of macroeconomic variables. Those macroeconomic variables are distilled into a single measure, and that single measure is used in the rest of our analysis and our framework, and it gives us an idea about where do we stand in terms of aggregate economic sentiment. As I said before, these are the three measures that we have currently studied, but the framework that we have constructed can actually handle multiple themes, and it can be open to interpretation by the end user. Now, I would like to focus a little bit on a set of measures, a set of variables that are constructed using information that's coming out of the market. The first one we call fragility, and what we're trying to do is we're trying to capture financial frictions that are related to the financial soundness of firms, and this financial soundness of firms can be thought of as a proxy for aggregate distance to default. So in order to properly construct the distance to default measure, one needs to take into account balance sheet information, financial statement information, which is not available at high frequencies. Luckily for us, advances in macrofinance help us construct measures that do have a more timely component, meaning we can use information that's coming from the markets to construct a measure of fragility, and that measure of fragility is always available even at a daily frequency. Now, what do we observe about this measure, and why do we care about this measure? First of all, we observe that it is a pro-cyclical measure. It does reach its lowest level during the Great Recession, and it also started pointing down again recently in the current recession. That's an indication that the aggregate economy moves closest to default. So each time this measure goes down, distance to default goes down as well. So the economy in general becomes less robust. It becomes closer. It gets closer to default. Now, this measure has some interesting properties, and those properties have to do with recessions and recessions associated with the financial crisis. What we observe is that each time this measure dips, there is an increased probability of a recession occurring, and that recession being associated with a financial crisis. And this is not only true for the US, but also for a large panel of countries. Then Another measure that's computed using not macroeconomic information, but market information, but instead is targeting macroeconomic information related to the amount of information that's being produced by agents in the economy, is that of volatility. Our definition of volatility might be a little different than the commonly accepted definition of volatility. What we mean by volatility here is dispersion in the beliefs of agents in the economy, investors, when it comes to the valuations of firms. So what we're looking at here is whether investors produce information or not. And we have seen that this production of information is again associated with instances of recessions, and more specifically, more strongly than fragility, instances of recessions associated with financial crisis. This measure does spike prior to recessions associated with financial crisis, and this is true for a large panel of international data. Now, as you can see, this is a countercyclical measure. So one would expect that exposure of different assets to that measure should be associated with a higher exposure to that measure should be associated with lower returns. And I will explain why that's the case. Now here, you can see what the correlation is among the measures that we have constructed and a set of macroeconomic variables. One can see that the correlation among the variables that we have constructed is not very high. The highest it gets is 0.6 for fragility and volatility, and that's due to the risk and behavior of those measures. This is an indication that we are incorporating information that's not fully correlated. There is information that's related to the specific macroeconomic characteristics, and that is expected to show up later in the construction of the portfolios and the properties of those portfolios, and how macroeconomic portfolios can actually expand the information set, the mean variance frontier of a systematic investor. Now, a few words about how we use that information within the context of a tactical asset allocation framework. We decided to keep things simple so that everything is tractable and we don't end up optimizing on the basis of hyperparameters. All of our assumptions are typical assumptions in the literature that describing topics like this, and we keep the parameters to a minimum. So first, what do? We start with a set of asset groupings. Those asset groupings can either be stocks that belong into an index, or it can be ETF or other indices based on global equities, country level indices, or even sector indices. And finally, we also have versions that are looking at within specific asset classes and also across asset classes. So once we have the individual assets, we can compute their exposures, meaning betas, to the macroeconomic measures that we have constructed. And the process is quite simple. We first estimate the risk exposures, the betas. Then we rank the assets on the basis of those risk exposures, and then we form portfolios with specific characteristics. Those portfolios can be long only, long short, or long minus some index or some benchmark that the investor might be targeting. Of course, more sophisticated versions of this framework can be devised, and we have created. But for the purposes of this presentation, I'm just going to show you some results from a plain vanilla implementation. Now, looking at a Russell 1000 implementation, one can easily see a number of clear patterns. So what do we have here? What we show on this slide is the average return and a confidence interval around that performance for stocks grouped into deciles or quintiles. In this case, we have quintiles on the basis of their exposures to the macroeconomic measure. So going from quintile 1 to quintile 5, we're going from low exposures to high exposures to the measure. And what we see here is a very clear pattern for the pro-cyclical and weekly pro-cyclical measures, meaning there is an increasing pattern of returns with respect to exposures. As exposures go up, return goes up as well for pro-cyclical measures. For counter-cyclical measures such as volatility, the opposite holds true. The reason why we observe that is the very properties of pro-cyclical and counter-cyclical measures. So if one can think about how investors assess risks and are comfortable with the risks that are taking. And in order to be comfortable with those risks, they need to be compensated for that. So for the case of economic output, which is a pro-cyclical measure, an investor, in order to hold stocks that have a high exposure to that measure, meaning those stocks appreciate in good times and depreciate in bad times, that investor will need to be compensated for that, because when it matters to them most, they're not going to be paid. So in bad times of the world, performance is going to be low for those stocks. And of course, the opposite logic holds true for counter-cyclical measures such as volatility. So a measure that has an asset that has a high exposure to the volatility measure is serving as a hedge for bad times, for times where recessions are associated with financial crisis. So in order to hold this asset, the investor is willing to pay a premium, which is an insurance premium in this case. On this slide, I'm showing you how one can combine those portfolios and what the performance of those portfolios is. The first 5 columns of the summary statistics table are reporting the performance of the individual micro portfolios, which are long-short portfolios, meaning going long at quintile 5 and short at quintile 1, over the course of 2005 until July of 2020. What we can see here is that pro-cyclical measures are associated with a positive risk premium, whereas counter-cyclical measure, our volatility measure, is associated with a negative premium. Output, inflation, and sentiment portfolios, they all have statistically significant alphas, either measured by French 5 factors or Carhart 4-factor model. Whereas fragility and volatility do not exhibit statistically significant alphas. Our interpretation of that is that output, inflation, and sentiment are bringing information that's not necessarily already incorporated into those factors, whereas fragility and volatility are offering another way of thinking about combining those factors or making tactical shifts across those factors. We also consider 2 versions of combined portfolios. The first version, which is the version that we show in the paper, is the macro 1, and this is an equal allocation across the output, the inflation, and the sentiment measure. Now, this is important. The combination of those portfolios together is important because it tells a story of how diversification across macro factors can actually improve performance overall. And this is exactly what we observe here. If you look at the Sharpe ratios of the macro 1 implementation, which is an equal allocation to output fragility and volatility, and macro 2, which is an equal allocation across all 5 portfolios, what you can see is that those Sharpe ratios are higher than any of the individual Sharpe ratios that we observe here. Again, our way of interpreting this finding is the fact that our measures are not fully correlated. They're not perfectly correlated. There is information that's unique to each one of them, and that information actually exhibits itself in the form of increased performance, risk-adjusted performance when combining portfolios constructed using this kind of macroeconomic information. Moving on, and to actually make this point a little bit stronger, we went and did a very simple analysis where we added those macro portfolios into the mix of Fama French 5 factors or Carhart 4-factor model. And we did that in a not ex post setting by estimating a mean variance efficient frontier using different combinations of those portfolios. What we observe is that the inclusion of those macro portfolios into the mix of existing and popular and commonly used factor models is actually increasing the Sharpe ratio quite significantly. You can see that for the case of the Carhart 4-factor model, we go from a Sharpe ratio of 0.75 to a Sharpe ratio of 1.27 by including those macro factors. And the same holds true for the case of the Fama French 5 factor model plus a momentum factor. The Sharpe ratio, again, it goes up from 129 to 171. A visual representation of that can be seen on this slide. What we observe here again is that the efficient frontier is shifting to the left. This means that one can construct optimal portfolios across those individual portfolios that have higher Sharpe ratios than any individual portfolio or any other combination that does not include macro factors. At this point of the presentation, I would like to focus a little bit more on alternative groupings of assets. We saw that these factors do work quite well for individual stocks that are in the Russell 1000 universe, but what happens if we decide not to use individual stocks, but instead use ETFs or indices or baskets that describe things like sectors, individual country level performance, fixed income portfolios, commodities, and then cross asset implementations as well. What I show here is the macro 1 version, which is the performance of an equal allocation to output fragility and volatility. And I'm showing 3 different implementations. The first one is a long only implementation, the second one is a long short, and the third one is a long minus market, where market is, for the case of equities, market is the broader universe from which stocks are derived, and for the other implementations is an equal allocation across the individual assets of the grouping. So for the case of sectors, it's an equal allocation across all sectors. What we observe is that across the board, performance of the long-short version is positive, and for most implementations, that performance is very similar to the performance using Russell 1000 instruments. Similar results are observed for the case where we include all macroeconomic measures. Now, we wanted to dig a little bit deeper, and for that reason, I'm going to focus a little bit more on the cross-asset aspect of this implementation. And for this implementation, we're going to use 131 cross-asset ETF and index portfolios, and we're going to apply the same machinery, meaning we're going to start with those 131 indices. We're going to compute the exposures of those indices to the different macroeconomic factors. And once we have those exposures, we're going to construct long-short portfolios that are going to be rebalanced on a monthly basis. Across all of the implementations that I've shown you so far, the rebalancing is taking place at the end of the month when the macroeconomic measure is updated, and the signal is good until information is updated again at the end of the next month. What we observe here is a similar performance across all macroeconomic portfolios compared to that of the Russell 1000. And again, the interesting finding here is that the Macro 1 implementation is producing risk-adjusted returns that are higher compared to the risk-adjusted returns of the individual portfolios. One will observe that sentiment and inflation have a lower performance compared to the performance that those portfolios had using Russell 1000 indices, and this is mainly because we're using macroeconomic information from the US, and in the set of 131 cross-asset ETFs, we have assets that are coming from other parts of the world. So there is a bit of a mismatch in the actual information that's being priced here. This is something that we are trying to address right now by incorporating and introducing global versions of those factors, versions that are incorporating macroeconomic information that's across countries and across geographies as well. This is a very hard task because one has to make sure that the macroeconomic information that we're fitting into the model is as of a specific point in time, and it's clean and accurate and reflects the actual state of the macroeconomy. And of course, as we move from the US and Europe to other parts of the world, quality of that information degrades quite substantially. Again, one can see that the performance is overall positive. There are instances of negative performance, and that negative performance is something that we want to. This is something that we do want. That this is something that we do intend to see in the model, because in a model like this, if you want something that's giving you exposure to the phases of the business cycle, when economic downturns hit, performance is going to suffer as well. But if the end user has a view on the state of the macroeconomy, then we can very well reverse the signals And in times of downturns, you can be long you can be long quintile 1, which is the lowest exposure to the factor, and short the highest exposure to the pro-cyclical factor. And with that, I would like to conclude the presentation and opening it up to questions. Thank you.
Great stuff, Kyriakos. That was really interesting. Yeah, had a couple of questions come in. One was, what is the most important macroeconomic factor investors should consider? Was there anything that came out on the findings on that?
So I would say that the 5 factors that we have included in this framework are some of the most important and easy to measure factors that one can consider in their tactical asset allocation decision-making process. We are currently working on versions that are looking at recession expectations, unemployment, which has recently become a very hot topic, and additional things related to housing, global imbalancings, and so on and so forth. But I would say that at a starting point, macroeconomic growth, inflation, and sentiment are the go-to factors when one wants to start working and wants to start using those terms in their decision-making process.
Good stuff. I think we have time just for one more. Can investors cut through the noise through the macroeconomic factors to potentially bypass convoluted narratives, or is that just not possible?
They can, and this is the reason why we're focusing on the monthly versions of those factors instead of daily or weekly versions. There's a lot of noise when you're computing those factors on a daily or weekly basis. Macroeconomic conditions do not shift that often, and when they do, it's very clear to us, and it should be very clear to us that they have shifted. That being said, there is a lot of merit into looking at higher frequency versions of those macroeconomic figures, but one should keep in mind that there is a fair amount of noise associated with that, and train their models to address that problem.
Great stuff, Kyriakos. So that's all we have time for, but yeah, much appreciated for jumping on here. Yeah, that was really interesting.